Hello, friends. Starting with one of the very interesting topic, which is very trending also nowadays, that is the derivative trading strategies. Now, first of all, we should understand that derivatives came to this world to transfer price risk from one party to another party, and you can also see a lot of statistics released by SEBI. So the strategies that we are studying right now are not at all a recommendation to get into. We are purely learning for the academic purpose. So I originally had an idea to take all these strategies much earlier, but yes, due to like a bit concern, I was not doing it. But now I thought, with the disclaimer that this is purely for academic purpose to clear CWM examination, we are learning all these things. This is not at all a recommendation to any of the trader. This video is not at all for any of the derivatives trader. Right. Okay. Let's begin. Now, we have studied so far all the different components of derivative. Now, there is a new series which I'm starting with, which talks about all the derivative trading strategies. From covered call to calendar spread, we are going to study all these things in next couple of months. The first one, very common. I've seen many of my students like doing these strategies for their clients and making reasonable amount of money, but still, I'm saying that it is only for academic purpose. It needs a lot of expertise along with risk management to get into all these things. So first one is covered call. Now, what does this mean? When to use? That's the first thing. All these strategies have some rationale, some intuition behind, and based on that, one gets into the strategy. And if his assumptions go right, he will make money. So when to use this? This is often employed when investors are short-term neutral to moderately bullish view on the stock he holds. So covered means he's having stocks and he's taking a derivative position on it. So he says that market is going to remain in a particular direction, moderately bullish direction, and he already has a few stocks. He takes a short position on call option to generate income from the option premium. Now, say for example, talking about Reliance. So 250 is the lot size of Reliance. So say for example, I do have 250 shares of Reliance with me, and I understand stock is mostly a range bound stock, which is not going to like increase 10-20% in short period of time. So say for example, current market price of Reliance is 3,000. It's not there, but just for example, I'm taking it 3,000, right? And I'm not anticipating Reliance share to exceed say 3,100 rupees in a particular month before the expiry comes in. Then what I can do is I can sell the call. Now this is out of money call, so I'm selling out of money call. I do have 250 shares of Reliance, and I anticipate that it will not exceed 3,100, so I'm selling out of money call on 3,100 of 3,100, and I'm earning premium from it. So let's say Reliance stock increases during a period and goes up to 3,050. Along with that, say for example, I earn 20 rupees premium. So this is my extra profit which I could earn from this particular strategy. Like many traders help their clients to take this kind of strategies to make income. Because it is covered, it is less risky, but still, if there is no need of getting into, don't get into. Okay, now take this example. Mr. A bought XYZ Limited of rupees 3850 and simultaneously sells a call option with a strike price of 4,000. So we can understand it's out of the money option, and he receives a premium of 80. Now, in our examination, what should we be learning? You should be able to identify what's the profit if a particular price happens to be, what is the break even point. All those things are required in our examination. So these are the things they ask. So they ask break even point. If they give you a particular price, then what could be the profit, what could be the loss, all those things you have to know. Now, because this option is with a strike price of 4,000, option will not get exercised up to this point. Now, whatever movement happens here, that is in the stock only. So say for example, if the price is 3,600, you are losing how much on stock? So 250 is your loss. There is nothing on call. You have received a premium. So you got a net amount. Then once again, at 3,700, you are losing 150. And you got 80 rupees premium. That is once again a net amount. Now at 3,740. At 3740, how much do you lose? 110 on stock. There's nothing on call. You have still received a premium. There is a net, say it is minus 30. Now at 3770, you are losing how much? 80 plus 80, and this is 0. Now, with a few problems like this, by trial and error, you can easily find out the break even point. Every strategy has its own unique formula to find out break even. So, with obviously bit of practice, you can understand those formulas. But yes, initially you can have this trial and error, like you can assume different prices and try to get closer and closer, and then you can easily arrive at the break even point. And we know that derivative is heavy weighted chapter in our exam. Now at 3800, you would be losing 50 on stock. There is nothing you have to pay from the call option. 80 is the premium received. So now it's above the break even point price. So you are into profit. At 3900, you are earning 50 from stock. There's nothing to be paid plus 80. So your net is 130. At 4000, 150 is the profit from the stock plus 80. So 230 is your net profit from this strategy. At 4100, your profit from the stock is 250. How much do you pay? Now call option gets exercised and you pay 100 plus 80. So that means your profit has been locked in at 230. So whatever be the price now onwards, it is going to be 230. This one we took with a clear assumption that current market price is 3850. It is moderately bullish, but we anticipated it is not going to exceed 4000 at a given point of time. Let me draw the chart of it, so that will also bring in a lot of clarity. This is the one which I like the most, drawing charts. So what's the break even point? As we identified, 3770. Now if the price goes further, say how much? 4000. So at 4000 our profit is locked in, and that is how much? 230 plus. Now downside, how much is my loss? So there is no protection downside, but it's a covered call strategy. So what was my assumption? It is moderately bullish. And however, now we buy a stock at 3850. To the extent of premium collected, I'm still getting bit cushion. So I'm at no profit, no loss at 3770. Right? So this is how we can create a particular strategy. This is the first one, most basic, and it is covered. Why it is covered? Because the trader has stocks backing his sell position. If there was no stock backing, we call it a naked position. So that is very risky. So this is the first strategy. In the subsequent videos, definitely we are going to get into further strategies. Our next strategy is straddle and then strangle. So keep connected. I'll give you more and more strategies. And once again, do not trade. It is for academic purpose. See you. Bye, everybody.